Hey everyone, it's Tim again, and I wanted to cover what happened this morning with the Federal Reserve, why it's impacting the market so negatively, and what do we need to do about this? So before we talk about that, let's talk about who is the Federal Reserve exactly, and what did they say exactly that's going to affect you and I, and why is it freaking everybody out? But more importantly, what should we do to prepare? All right, let's just get right into it. So number one, the Federal Reserve is the central bank, and they help set what they call monetary policy and fiscal policy. In other words, it's a fancy way of saying that they control the interest rates. They also control the money supply, and they're supposed to make sure that the financial markets are stable. Now, they are given two mandates from Congress. First mandate is stable prices. The second mandate is maximum employment, with stable prices having precedence or priority over maximum employment, okay? So what exactly happened today? Well, the Fed gave a speech down at Jackson Hole, which is just basically a big gathering of a bunch of central bankers from around the world, and they discuss like monetary policy and fiscal policy. Basically a bunch of nerds, and they're setting the cost of money, talking about interest rates and the market. Okay, at least they try to control the shorter maturities, like the overnight rate is really what they control, but that kind of rolls down to the other rates, or it trickles down to the other treasuries out there and different interest rates that are out there. So let me show you exactly what happened when they talked this morning, and then we'll discuss what they said, and we'll discuss why all of this stuff kind of came together. All right, so first thing, let me first start off by showing you this. As you can see here, right when the Fed started speaking, just a few minutes into the speech, and the market just tanks, right? I mean, it went down. It's down right now at 2.23%. Okay. Now let's take a look at the bond market and look at what happened there. This is also not good stuff. So you can see here that the 12-month, the 6-month. Okay, so if you look at the yield on the 6-month, it's 3.21. But if you look at the yield on the 10-year, it's 3.03. So what that's telling us is right now the market feels like there is either a recession or we're going to definitely be in one within the next 6 months. So that's what they're pricing in. They're pricing that in, and you can tell that because the interest rate here on the 10-year note is lower than the interest rate you would receive if you just, so let's put it this way. If you lent out $1,000 to the government and said, hey, I want this back, this $1,000 back along with 3%, 3.21% interest in 6 months, and then I can reinvest it or whatever. And hopefully by then the interest rates go up, but either way you can play with it. Or if you want to go with the 10-year treasury, which is going to be if you want to lock your money away long term, you're only going to get somewhere around 3.03%. Right, so the markets are telling us whenever these bonds do what they call invert, it tells us what to look for and when. The when is based on what you're seeing here, what we've been looking at with the inversion of the yield curve. If you start to see the 2-year invert, that means that they think a recession is coming within the next 2 years. Likewise, if you see the 6-month invert, then the markets are telling and screaming to us, hey, something's already happening, it's already about to get real bad. So I think everybody kind of expects that, right? So what exactly did the Jerome Powell, what was he talking about this morning? Okay, and it wasn't so much that he talked about like raising interest rates a lot faster, but rather he said this, and I'm going to quote as closely as I can. Okay, restoring price stability will take some time, and it requires using our tools forcefully to bring down demand and supply in better balance. Reducing inflation likely requires a sustained period of below-trend growth. Moreover, there will likely be some softening of labor market conditionings. While higher interest rates, slower growth, and a softer labor market continues, it will bring down the inflation. but it will also cause some pain to households and businesses. Those are the unfortunate costs of bringing down inflation. End quote. Okay, so let's just break down what he's saying. Him coming out and saying a sustained period of below trend growth, that is, and then on top of that saying the softening in the labor market. So those are screaming for, earnings to come down, which then causes the price of stocks to come down, right? But here's what's moreover. They're gonna start releasing and selling all of their mortgage-backed securities in the next 9 days. Well, you ask, well, why is that such a big deal, Tim? Well, let me just show you a little something, okay? I remember this quite well. All right, right here is the chart of asset securities held outright mortgage-backed securities, Wednesday's levels. So if you look at the mortgage-backed securities, they really started buying them in 2008. And as the market was horrible, they just kept on buying and buying and buying, and that was their peak, and kind of got to the point where this was the point where they were like, hey, we're done buying, we're good with buying. Then sometime in 2018, the Fed decided that it was time to start tapering, okay? And as they did, you can see here, they started actually all they did was let maturities of these mortgage-backed securities roll off their balance sheet. Meaning that if somebody sold their home and paid off the loan, they would just become the paid off loan. They would not replace that mortgage-backed security. They wouldn't do anything. They would just let it mature, and then they'd shred up the money, basically. Okay, so you can see here, whenever they started this tapering process, the market had a fit, and like they had to turn around. They had to turn it around in 2019. They had to cut the interest rates. The Fed was forced to cut the interest rates because the market was just having what they called a taper tantrum. Now listen, I know it doesn't seem like a big deal, but in 9 days is what I think we need to really be watching for. We also need to look for the next CPI read. We have to see how hot that's coming in. Here's another little thing that we got to look for. When we look at what just happened with the government, they're putting out basically more stimulus to the tune of almost 500 billion. And I think I think that Jerome Powell was very frustrated when he was giving his speech today. I'll put a little link to it below so you guys can watch it. It was like 17 minutes, not too long, but he was very firm in his voice. Like when I said that he talked about being forceful, he's saying, I'm going to crash the market. I'm going to cause a recession. He even said, look, there's going to be some job losses and some businesses are going to go under. That was the basic tune of what he said. The market didn't like that. So anyway, it started selling off. And who knows, maybe next week we'll bring some better news. But that's all for now. Anyway, if you like this content, consider subscribing, liking, and sharing. All right, folks, talk to you later.